Tesla just reported earnings and the stock jumped 10%, but shares are still down 42% this year and 60% from their peak. Based on the after-hours share price, the company now has a market cap of $555 billion, with $22 billion of cash on the balance sheet and $2.7 billion of debt. This was a concerning quarter for Tesla, with automotive revenues dropping 13%. Unsurprisingly, given the huge cost of auto manufacturing, gross profit fell even further, with an 18% decline. Operating margins fell again to just 5.5%, which is lower than most legacy automakers, even General Motors. And Tesla's free cash flow turned negative for the first time since 2019. Of course, Tesla's decision to cut prices on its cars is mostly to blame, but the company is also suffering from high interest rates and softening demand for electric vehicles. Based on trailing 12-month figures, the company is now valued at almost 6 times revenue, 41 times earnings, and almost 400 times free cash flow. In other words, Tesla stock still isn't cheap despite falling 60%. On the positive side, Elon Musk said on the conference call that total volume for this year would still be higher than last year. He announced plans for more price cuts and new cheaper models to roll out next year. The company has laid off 10% of staff, postponed a trip to India, and will be utilizing existing factories to build new models which will help keep costs down. A new $25,000 Tesla should help the company maintain its lead against its Western rivals. China, however, is a different story. Chinese automakers have huge cost advantages, and BYD recently launched a vehicle priced under $10,000. If Tesla cannot maintain share in China, the stock will remain under pressure. But focusing on the automotive business misses a crucial part of the Tesla bull case. This is a company with multiple sources of future revenue, from charging and storage to autonomous driving, AI, and robots. Increasingly, the investment case for Tesla seems to rest on whether or not the company can solve full self-driving. Even if a robo-taxi launch in August is premature, the company is clearly making excellent progress. Musk said that the company was in talks with one large automaker to license the software. A partnership like that is absolutely key to Tesla stock, because as a car company on its own, it's wildly overvalued. In fact, Musk summed it up perfectly when he said, "If somebody doesn't believe Tesla is going to solve autonomy, I think they should not be an investor in the company." Despite the short-term hurdles, Tesla is doing the right thing by focusing on affordability and self-driving. Considering Tesla's future potential in self-driving and all of its other ventures combined, I rate the stock a high-risk buy, but these are my personal opinions, not financial advice, and I do own a small position in Tesla. Thank you for watching.